Art says, I'll start by saying that the Rich Habits podcast is my favorite podcast. Thank you. Now, with regard to the emergency fund that you guys are always talking about, you suggest to have money set aside in a high yield savings account. What do you think about me putting that money instead into dividend stocks? My logic is that I could sell stocks at any time. My monthly expenses are about $8,000 a month. I've got a couple rental properties. So if I have $50,000 in an account that's only earning 3, maybe 4%, it feels like a missed opportunity. What do you guys think about this strategy? Robert, this is something I think I get the most flack on, which is like an emergency fund is not an investment account. You're not supposed to be earning 9, 10, 12, 15% on it. It's an insurance against your existing investments, right? It's the insurance that when it rains, it pours, like it always does in life, and you're going to have that $6,000 set aside to go do that thing, or the $12,000 that you'll need in case of this big thing happening, or whatever. With your 3 rental properties, you might need a roof, you might need something else and something else, $30K out the door like that. If it's in the dividend stocks, and let's say that these dividend stocks are experiencing a 10, 15, 20, 25% correction like they did in 2022, well, congrats. Your $50,000 is now worth $32,000, and you don't have the money you used to have if it was sitting in a high yield savings account, just sitting in cash, earning some interest and insuring against your investments that are in your retirement accounts, right? So now you drain your dividend stocks. They're down anyway. Now you got to drain the 401k or take a loan out or something stupid. We don't want to do any of that stuff. We want to have our 30, 40, 50K sitting in our high yield savings account, earning 3 or 4%, allowing us to stay invested with our 401ks, our Roth IRAs, and our bridge account so that those investments don't need to be touched, don't need to be borrowed against or cashed out or anything at an inopportune time.
I couldn't agree more. And I always tell the story about what 1 year looks like for most people. And it kind of goes like this. We're going into springtime right now. Guess what's happening? Wedding season. So you're going to get invited to all these weddings. You're going to put it on the credit card. You're going to take money out. You might even sell some crypto or stocks to go do that wedding. And what most people do is they say yes even when they can't afford it or haven't budgeted for it, because maybe this year is the year that more of your friends get married. And then you find yourself in a situation putting the money on credit cards. So wedding season's over. We're getting into the fall. You're paying down the credit cards. You're getting back on track. Holidays are here. Christmas happens. Boom, boom, boom. You're ready to rock and roll. It's an endless cycle. And like Austin alluded to, the emergency fund isn't because you can't get your money out of stocks. I can right now ask for a wire of $100,000 or $1 million and have it in my account in a couple hours. But the problem with that is if that money is invested and it's pulled out, it's a taxable event and you're robbing from your future for something you want to do today. That's why the emergency fund is great, because it's liquid. It's not a taxable event when you use it. And it puts you in a situation where you don't use the credit cards when something pops up. So keep that in mind. I love it. Always understand the emergency fund is not an investing account. It is for emergencies. And emergencies can be tires. It can be something at the house where you have a bad, hot water tank. It doesn't matter what it is. It's to keep you from using the credit cards or pulling money out of your retirement accounts.
Yeah, a good example of an emergency is Christian, as you guys might know. He's our partner here in the podcast. He had a burst with his pipes underground in the new house he bought and whatever. It's like $15,000 he had to come up with in 2 weeks to go pay these people to fix it because his water wasn't running and it just didn't work, right? So it's like these emergencies can be, especially you mentioned 3 rental properties, they can be thousands, if not tens of thousands of dollars that you might not be able to see coming. And if you have money invested into dividend stocks that for whatever reason we might be experiencing a contraction or a pullback in the markets, now you got to sell at a loss to go cover an emergency. Or if you don't want to sell at a loss, you got to borrow on some credit cards. Like it's a mess, dude. Don't dabble with it. Have your high yield savings account. Use it for emergencies only.
I love it. And that is what makes our 30-year age gap so special, is because, we have 2 spectrums. We have all the stuff and all the crap I've gone through over 30 years and 35 years of investing and building my portfolio and my wealth. And then we have you, this brainiac, nerdy guy that's just really, really good at what he does. And combining all of that experience and stories and knowledge really helps us break down difficult subjects in two different ways. And that's what I love the most about these Q&A episodes is us being able to really unpack it from two perspectives to help people make that educated decision, because personal finance is personal.
I couldn't have said it better myself, Robert.